Now, consumers aren't feeling too confident about the economy. In fact, they haven't felt this bad about it since November. So U.S. consumer sentiment dropped to a 6-month low in May. And this is amid growing anxiety about inflation, rising unemployment rates, and high interest rates as well. So the University of Michigan released its latest consumer sentiment index today, and this month's reading came in much lower compared to the last month. And it is the lowest since November, as I mentioned earlier. Consumers expressing worries that inflation, unemployment, and interest rates may all be moving in the wrong direction here and bracing for even higher price increases in the year ahead. So this consumer sentiment index is actually closely tracked by the Biden administration. So keep that in mind. And earlier, I talked to Chief Economist Peter Schiff at Euro Pacific Asset Management for why he thinks consumer sentiment is so low and for his outlook on the U.S. economy. Take a listen. Peter, great to talk to you again. Consumer sentiment out today, lowest in 6 months, it looks like. And Peter, let me just point out, it's not just that. The most recent jobs report, sharp drop in jobs added. Unemployment up. The most recent GDP estimate coming in low. And just yesterday, jobless claims, highest in 8 months. Peter, what's happening here?
Well, if consumers only knew just how much worse it's going to get, confidence would be even lower. They're actually a little bit too optimistic about the future. What they're really concerned about is rising inflation and high interest rates. And the problem is interest rates aren't really high yet. And unless the Fed raises rates even more, inflation is going much higher. So the Fed is in a box if it tries to raise consumer confidence, because if it tries to fight inflation, which is worrying the consumer, it's got to raise interest rates. But that's already worrying the consumer. And so higher rates to fight inflation may cause confidence to fall even further. On the other hand, if the Fed doesn't raise rates or cuts them as planned, inflation is going to get a whole lot worse, which means consumer confidence can only go down. The Fed is planning on reducing rates, despite the fact that rates are still too low. But the problem is Americans have so much debt that even these low rates are too high. That's the main reason the Fed stopped hiking, because we started to see another financial crisis as the banks started to fail. And the U.S. government is in a bind fiscally. Every time the Fed raises rates, it causes budget deficits to widen, because now the government has to spend more interest to cover its debts. Plus, it also weakens the economy, so tax receipts go down. So as the budget deficits are swelling, that puts more upward pressure on inflation. And so as the Fed tries to fight inflation by hiking rates, it just ends up making it worse.
So are you seeing inflation flaring up again? Because we did see CPI go up for the past 3 months.
Yeah, well, inflation's headed back up. I mean, it only went down temporarily. That decline from 9% to 3% was transitory. Now we're headed back up. We'll be above 9% before we get down to 2%. I have no idea when we're going to get to 2%. It may not be for decades.
How's the consumer doing? Because if we're looking at the most recent earnings reports, I'm talking about McDonald's and Starbucks here, it seems like the consumer may not be on such solid footing.
No, he's on life support right now. The consumer's in a lot of trouble. He's got a record amount of debt, credit card debt, household debt. Savings are totally depleted. The cost of living has skyrocketed and is going much higher. And a lot of Americans are now holding down multiple jobs just to make ends meet. People are working evenings. They're working over the weekends. That's why we have all this job creation, because people are moonlighting. You need 2 or 3 jobs now to pay for what one job used to provide for just a few years ago.
Just a few months ago, a lot of economists, analysts, they're predicting a recession in the economy. Now nobody sees a recession. What's your base case for the economy?
Well, they're blind. We're probably already in a recession. I mean, a lot of the numbers that we're getting that indicate otherwise are probably going to be revised lower, probably after the election. But not only are we going to be in a recession, or we're already in one, but inflation is going to get worse. So it's stagflation. And Powell just said at the last press conference he doesn't see any signs of stagnation or inflation. And he's wrong on both counts. I mean, the signs are obvious to everybody, maybe except the people on the FOMC who couldn't see the 2008 financial crisis coming, who believed that the 2021 inflation was transitory. They're wrong again. This is stagflation, except stagnation is going to be more like depression. And the inflation part could be closer to hyperinflation. That's how bad it's going to be.
What does the U.S. need to do to turn the ship around?
Well, I mean, at this point, I don't know that you could turn it around. It's a little late for that. But there are things that we could do to mitigate the damage when, we collide with the iceberg or whatever we're going to hit. But what we need is dramatic cuts to government spending. We need much lower budget deficits. In fact, it'd be nice to have some surpluses to start paying down the debt. But the government is doing the opposite of what it needs to do. It's increasing spending. And so it's making the problem worse. So I don't see any political will in Washington to take the steps that are necessary to soften the impact. So we're going to, hit full steam ahead. And so, people have got to just brace themselves for that impact and do what they can to protect their wealth because, the government's not going to do anything and neither is the Fed.
All right. Thank you very much today, Peter Schiff. Always great to have your insight, Euro-Pacific Asset Management.
My pleasure.